Hello everybody and welcome to the episode on my channel. So this week we have something really exciting for you viewers. I've decided to go ahead and rank all of the stocks in my dividend growth portfolio here that I share with you on YouTube. And now I've seen other YouTubers do this, and every time I watch this type of video in this format, it really provides some valuable insight into their investing thesis. And I think it could provide some valuable insight into my investing thesis to you as to why I invested into these companies. So without further ado, let's go and dive right into the video. So the way this works is these stocks right here will be given a grade as either S, A, B, C, or D. Now S being the best, D being the worst. S here can stand for superior or superb, A stands for grade A, B stands for grade B, C stands for grade C, and D stands for grade D. So I like to think of these more as like, this is like in grade school, the rating system that you had in grade school on your report card, A being the best, D being the worst, and then S right here being exceptional or superb. So let's go right ahead and start with my first company. We have Microsoft. Now I'm going to put Microsoft here in the S tier. It is my largest holding, and that is for a very great reason, or a very great couple of reasons. So Microsoft has a huge moat. They have an amazing suite or array of office products that are used in business, such as Excel, Outlook, PowerPoint. They have a operating system that is used on the computers, otherwise known as Windows, and that is used by businesses and individuals all across the globe. Now they are also making great headway in the cloud computing space, and they are the second leader in that space, right behind Amazon Web Services, and that is with Microsoft Azure, and they have been growing that business at compound annual growth rates of 20% plus for the past couple of years, and that has just been adding to their moat or their success. One other great point here is that Microsoft is making significant room for improvement or significant expansion, I would like to say, in the AI or artificial intelligence space. Everybody has heard about ChatGPT now, it's being used, but that is just, I think, the nibble of the biscuit. They're just kind of starting out here, and I think that is going to provide great growth avenues for Microsoft in the future, and consequently that is why Microsoft is my largest position. Okay, up next we have Apple. And I think Apple, is right up there with Microsoft in terms of the rating here. It's a superior company, or exceptional in my opinion. I have an iPhone. A lot of people in the world have iPhones. They are just selling these iPhones and making constant recurring revenue, as well as they are buying back shares. All their financial metrics here of Apple scream great results to me. Also, the products that they have and the ecosystem that they consequently put you into is astounding. So for instance, one of the best things I love about Apple is I have my iPhone, I have my watch, I have my Mac. They're all linked simultaneously and instantaneously. I don't have to do anything. Everything works well within the ecosystem because they design the hardware and the software for their customers, for their products. So Apple is a great holding. I'm going to be holding it for the long term, and it is actually, I believe, my third largest position, around 7% of this portfolio. Next we have TD Bank. So I'm going to give TD Bank an A rating. So TD Bank here, if you're unfamiliar with the banking system in Canada compared to the US, I'll kind of go over that quickly, but in the United States or the US, the banking system is more fragmented and there are a lot more players. I believe there's around 24 to 2,500 financial institutions. So there's a lot more competition, and it's not really as monopolistic as it is here in Canada. Now in Canada, we have about what they call the big six banks, being RBC the largest, TD the second, you have Bank of Nova Scotia, CIBC, you have BMO, and then National Bank. Those are the six largest. Now, what's really great about these banks is they have very monopolistic features, meaning that there are only a handful of them, and they operate in this basically oligopoly, if you would call it, of banking. Now, TD is one of these banks that I feel is poised for great growth because they have great expansion opportunities, not only in Canada, but in the United States. And they've been paying a dividend for a long time. They have very profitable business segments, such as their personal banking, but also wealth solutions, they have TD insurance, TD finance. Like they are very diversified in their revenue stream and they continue to keep on growing. So in my opinion, I would rank TD in the A tier or give it a grade A rating. Next, we have Brookfield Corporation. Now, I'm kind of straddling on the S and A, but I really believe that Brookfield Corporation, and again, it's hard to see these logos. They're kind of cut off in the tier maker, so I'll reinstate the names if you're not familiar with the logos or the logo coloring. But this right here is supposed to be Brookfield Corporation. Now, Brookfield Corporation, I've done a video on it. I think it was about 40 to 50 minutes a couple of weeks ago. So if you haven't checked that out, I encourage you to watch it, and you'll see why I believe Brookfield Corporation is one of these exceptional or superb companies. They are an alternative asset manager. They manage almost $800 billion of assets under management for their investors. And they invest in, like I said, what are called alternative assets. So they invest into things like hydro dams, solar power, wind power, real estate. So all of these different type of cash flowing assets. They invest in renewable energy. Like I said, they've just made huge investments into India. They're global, which is great, but they earn very high rates of return. And they are one of these companies that I feel will be poised for great growth just with the future sort of tailwinds that the global economy will have. So I rank Brookfield Corp as an S or superb company here in my dividend growth stock portfolio. And again, just watch that 50-minute video and you will see why. All right, next we have CP Rail. So CP, I would give it a rating. So Canadian Pacific or CP Rail has now merged with Kansas City. They are one of the big big class 1 railroads. And I also did a video on why I'm so bullish or why I invest a decent amount of capital into my railroad holdings. So if you haven't checked that out, I encourage you to scroll back and go to my channel and check out that video. But basically, CP Railway, now it has merged with Kansas Railway, and it has the direct railway going across from North America all the way into Mexico. And I believe this will provide great synergies in terms of their operations, but then also result in great financial metrics or great financial results for the shareholders such as myself. So I think it'll be poised to greater operating income, greater cash flows, resulting in greater dividends and share buybacks. So CP, again, I consider it as a grade A company. Next, we have American Express. American Express, I would put over here as a grade A company as well. So again, American Express, if you're not familiar with that, again, most of these holdings I've done videos on, so please feel free to go and check out my channel to scroll back and see the video I had on American Express. But American Express operates in a very cool business. So they are a payment processor similar to Visa and MasterCard. But what's really cool about American Express is they own essentially all of the transaction in that payment processing category. So as opposed to Visa, which gets a percentage of each swipe that you do or each transaction, and it's a smaller percentage, and then the other part of that percentage in that transaction goes to the issuing financial institution and to the credit card merchant. Here, American Express actually gets the lion's share of that revenue because they are also the card issuer and financier of these transactions. Now, what's really cool about American Express is that they offer great rewards to very affluent customers. So what I mean by that is a lot of their customer base is in the higher income categories, and by doing so, they get when these customers, by virtue of being a higher income earner, a lot of them spend a lot more money. So American Express transactions usually are on the higher side of that than Visa, which results in great revenue for them and great profit. Now, American Express is sort of what I like to call growth at a reasonable rate, as opposed to some of these other companies in my portfolio. Well, comparing it to Visa, Visa, grows at 20-25% per year in terms of their revenue and operating cash flows and things like that, and even their margins. Where American Express is more in that 12% range. So American Express is growth at what I call a reasonable rate. So in my opinion, it's a great company. Capital allocation strategy and their management is very, very sound. I feel very comfortable investing in American Express. I just know that it's not in the S tier or exceptional because it doesn't provide these huge rates of return, but they will be above average market returns in my opinion. So for that reason, I'm keeping them in the grade A tier. JP Morgan. So this is JP Morgan. And again, JP Morgan being the largest bank in the United States. JP Morgan, now this is a case of just being a great bank run by a great management team and run by a great CEO, Jamie Dimon. So I think that JP Morgan is an awesome holding in my portfolio. Provides great steady dividend income. The financial metrics are great. The capital allocation and capital discipline of management, including Jamie Dimon, is superb. I believe that with him at the helm, I am holding on to a super great company, and all of their financial metrics scream like a great company in my opinion. So that is why I have classed them in the grade A tier. Now again, I'm not expecting crazy returns. I'm not expecting 20% a year. I'm kind of expecting that 12, 13 to 14% per year annual growth rate, or that return to me as an investor. So for that reason, they're in the grade A tier. They're not in the grade S. I don't believe they'll compound at as high a rate as Microsoft, Apple, or Brookfield, but they are a great company nevertheless. All right, Texas Instruments. So Texas Instruments, I believe that this is also a grade A company. Now, I did do a video on Texas Instruments as well. You can check that out in my previous videos on my channel. But Texas Instruments, if you're unfamiliar with them, they make semiconductor chips and specifically analog chips. So when you think of computer chips, you kind of think of those super high tech chips that fit into your computer, and they're super complicated. But Texas Instruments makes what are called analog chips or power source chips. So those are chips that essentially control the power source for the device. So while computer chips are essential, for each of those computer chips or computer products that you have, they need power to function. So these analog chips are just as essential to those devices. So what Texas Instrument does is they fabricate or make these chips, and then they sell them to their various customers across their across manufacturing sectors or car sectors or vehicle transport sectors. So they have a very diverse revenue stream in that sense, and they have one of the most disciplined ways to return shareholder capital and essentially invest their capital across their needs and shareholder needs. Now, they have been in the top 1 to 2 tier percent for the S&P 500 over the past 20 years in terms of return on invested capital. So again, watch that video I made on Texas Instruments and you'll see why I think it's a great company. But this is a grade A company in my opinion in my portfolio, and I am happy to hold it. All right, next we have Visa. So Visa, I think Visa is in the S tier. So this is a superb company. I made a video on Visa as well, so check that out if you haven't. But Visa is a payment processor. Now, how their business works is that they, off of each transaction, like I said, they get a small percentage for facilitating or processing that transaction. Now, what's really great about their business is it's super high margin. So they're getting about 50%, I believe, as a gross margin. And again, an operating margin, I believe it's 40% or high 40%. So for every dollar of revenue, they're getting 40 cents in operating income. It's great. It's just a great business. They don't have to invest a lot of capital or funds into their business because it's so scalable. They can reach a wide audience because a lot of people, they use credit cards. Now with each swipe, it doesn't really cost a lot in terms of having technology or needing to invest into other technologies to increase the amount of revenue that they get, because it's such a great business model. Naturally, with inflation, as dollar prices rise and those credit cards are swiped, the amount per transaction naturally goes up, and therefore Visa ends up grabbing more revenue, and they reward shareholders in one of the best ways I've ever seen. They have a lot of dividend growth. They have been buying back shares at a very high rate, and they just are one of the best companies I've ever seen in my life. So that is why I've created Visa in the S tier or superb or exceptional tier here. Costco. So Costco, again, I think Costco here belongs in the S tier. So Costco, if you're familiar with Costco, it is a wholesaler. Now what they do is they charge membership fees on basically the ability for you to be able to shop at their Costco wholesale stores. So Costco, by charging this membership fee, it's an annual fee. It's like recurring revenue or subscription revenue. It's very, very sticky. Their customers usually renew, I think it's at a 94 or 96% annual renewal rate. So they're keeping those same customers and adding customers all the time. And what they do is they sell bulk merchandise to you for a very, very low cost, keeping their margins very low. So they keep their operating or their profit margins at like 2 or 3%. But the beauty of their business, like I said, is in that subscription revenue. That is basically all taken down to the bottom line. And it's just a great business model. I don't think Costco is going anywhere. They again are how I said American Express is growth at a reasonable rate. Costco is very, very high growth, but it's controlled growth as well. So by that I mean management is very careful. They don't open 100 warehouses per year. They actually open around 30 to 40 per year because they want to make sure that they are able to keep up with the demand of the store and the warehouses, and they don't want to expand at exceptional rates and therefore outgrow their business or grow at too fast of a pace for them to keep up. It's a very great company in my opinion. Now we're going to look at Lowe's. So Lowe's here, I believe they are actually in the A tier. And when we look at Lowe's, we might as well look at Home Depot as well. So Lowe's and Home Depot, I actually have, I believe, about 4% of my stock allocation in Lowe's and a lower percentage at Home Depot. And that was just in terms of valuation. When I was buying these two companies, Lowe's was a better valuation. So I added more of my funds into Lowe's. But Lowe's and Home Depot, they operate in a duopoly. So both of these companies operate in what is called a duopoly in the home renovation and home building sector. So what they do is they sell, and I'm sure you know, I probably don't have to explain this to you, but they sell various home building supplies from like lumber, they sell appliances, nails, screws, like garden supplies, anything and everything to do with the home or the outside of a home or maintenance, these two companies sell. Now what's great about these companies is, like I said, they operate in a duopoly. So I actually believe that these are two great companies in my portfolio, and just by owning both of them, I will get the benefits of growth in this sector by owning both of these companies. So I've decided to add both of these, and I think that they are great, great companies. They have high dividend growth. Now, Home Depot is on the lower side of the dividend growth, but Lowe's has been growing their dividend at a much faster rate. But that is because Home Depot is a little bit more mature, but Home Depot is the market leader in this sector. But I believe that Lowe's will have a higher compound annual growth rate or higher total shareholder return to me. And that is why I've kept my allocation at Lowe's a little bit higher than Home Depot. Again, two great companies, and I think that they have bright, bright futures ahead. And they are what I call grade A companies. Now we're going to look at Bank of America. So Bank of America, I'm actually going to put in the B category. So this is my first B here. So Bank of America is a U.S. bank, the second largest U.S. bank in comparison to JP Morgan. Now, I think that there's nothing wrong with Bank of America. It is a great company. The only thing is that I don't have as much. Again, their management is great. Their CEO is great. I just don't like if I'm comparing them to JP Morgan, I think JP Morgan is a full step up ahead of Bank of America in terms of their financials, in terms of their CEO, in terms of their upper management. And again, Brian Curran here is great in terms of being Bank of America's CEO, and they're great as well. But I just believe that Bank of America is not really up to JP Morgan in that standard, and that's why I've grouped them in the Class B category or given them a grade of B. But again, their dividend growth is great. They've been buying back shares slowly, and I think that they're a great company to hold on to. And I've actually added them because I feel that they're undervalued currently, and I think that they will provide a great total shareholder return or average or annual return to me in the future. Next, we have Union Pacific Railroad. So this, I'm actually going to put it in the B category, and that might surprise a lot of people considering how bullish I am on railroads. And this is the second largest railroad position in my portfolio, but I'm putting it right here under CP Rail because Union Pacific, again, just to reiterate, the railroads are a great companies. They have monopolistic features. They operate in this oligopoly of railroads. There's only a handful of them, class one railroads. They are great companies. I don't see them going anywhere for the near future or immediate future or even long-term future. But I'm giving Union Pacific here a class B rating or a grade B rating because they have a lot of improvements to make. So they've just decided to hire a new CEO, which is great. He was the old COO, and people are very excited about that. It actually caused their stock to rise, I think 10 or 12% that day that announcement was made. But they have a lot of areas that they need to, improve on. Now, when I compare CP and Union Pacific, CP is a full class above. CPN, it's not shown here, is CN as well, the Canadian National Railway. But the Canadian railways are miles ahead, in my opinion, in terms of things such as safety, complying with regulatory requests or information. They just have a way better grasp on that compared to the American counterparts, I believe. So Union Pacific has a lot of improvements, but I believe that over the next 10 to 15 years, they will move up into this class or grade A. They just have a lot of work to do, but I'm also betting that they will do well, and that is why I have a pretty decent holding in Union Pacific. And again, it is a railroad. It does have great average annual returns, or it has in the past. Again, those are not indicative of future returns, but again, UNP has great dividend growth. It's been buying back shares. I believe it's a great company. I just think that there's some improvements to be made, and then it could possibly move up to what I would call a tier. Right, next we have Brookfield Asset Management, and no surprise, just with Brookfield Corporation, I'm going to be grouping it as the S tier or superb or exceptional. Brookfield Asset Management is one of those companies that I believe you can hold, go to bed at night and not have to worry about anything. Their CEO, Bruce Flatt here, the CEO of Brookfield Corporation, formerly was Brookfield Asset Management. They did this spin-off, but Brookfield Asset Management, again, I made a full video on that one as well, but very sticky revenue sources. They manage these assets, long-term assets for their investors. They get great fees on those assets under management. This is what they call a capital light asset manager. So in this asset management company, they are again managing assets for their investors, investing them into great assets, alternative assets, and then they charge fees for which they collect them, and they distribute all of these out, or 90% of them out, as a dividend. So it's almost like a REIT, in my opinion, in terms of the payout. So it's a great dividend payer, as targeted great dividend growth. They're targeting 15 to 20% dividend growth, I believe, for the next 5 to 10 years. So great dividend growth over the medium to long term. And they are very capital light, so they do not have any of the debt on the balance sheet or anything like that. Like, super great company. If you haven't watched my video on Brookfield Asset Management, I encourage you to check it out. And that is why I'm going to classify them along with Brookfield Corporation in the S or superb tier. Great companies in my opinion. Vici Properties. So Vici Properties, I am going to give a rating here. So Vici Properties, and again, I apologize for the logos kind of being cut off here, but Vici Properties, they own specific real estate or casino buildings on the Las Vegas Strip. They are great real estate operators. They've been public not for that long. I think it's been about 4 or 5 years. 2018, I think I believe they went public. But what they do is they have these casinos and they rent them out to the actual casino operators, and then those operators pay them rent. Now, what's really cool about these rental agreements is that they're very long term, 20, 30, 40 years, and they are very stable. What's really cool as well is that within these rental agreements is built-in rent increases. So a lot of them are guaranteed 1% or 1.5% rental increases, or the higher of the consumer price index or CPI increase. So Vici gets a guaranteed increase on that rental revenue each and every year. And again, like I said, it's very stable. It's Las Vegas. People are going to keep going there for a long time. It's a great real estate in my opinion, or what they call trophy real estate. Now their financial metrics are also good. Their dividend growth has been amazing as well. So it's a very great company in my opinion, and I believe it belongs in the grade A tier. Agri Realty. So Agri Realty, I would probably group here in the B tier. You could make a case for it in the A tier as well. Agri Realty, if you're familiar with it or not, essentially I would think of it as a smaller O, or smaller realty income. So they operate specific or rent out specific properties, commercial properties, to the commercial tenants. And what's really cool about them is a lot of their tenants are what are considered grade A tenants, or a credit rating of A. So those are things like Lowe's, Home Depot. They have some other great dollar store tenants. So very great tenants that pay their rent, and then they are a REIT, so they pay out the majority of their cash flow or funds from operations to their respective investors, like myself. So very similar to Vici in that sense. And what's really cool is they pay a great dividend and a growing dividend. So as their funds from operation increase, they decide to increase their dividend and pay that out. So they are a great company. I still don't think that they are as great as Realty Income. That is basically the gold standard for REITs. But I think that they are on their way there, and I could see them moving to this grade A tier, in my opinion, in the next couple of years. And even going back, 10, 15, 20 years, they provided an average annual shareholder return of around 12% per year, so market beating. So I think on that basis, they have done very well. And you could make a case for them to actually be in the A tier right now, but I believe that, in my opinion, in my portfolio, they are in the B tier here. All right, next we have Rowe Price. So this is actually going to be, I might actually put it in this C tier. So this C tier. So that's actually surprising to me. I just made a video last week on Rowe Price. I'm actually very bullish on it, and I've been thinking about it this week. So Rowe Price is a great company. So they are what you call a traditional asset manager. So they manage your money for you, and they invest into stocks or bonds, or basically equities or fixed income, and then they charge a management fee for investing those funds for you. Now, what's really cool about Rowe Price is I really like their financial metrics. So they have a very clean balance sheet, no debt. They generate a lot of cash flow, and they pay out a lot of dividends, and they have traditionally had a lot of dividend growth. They're actually a dividend aristocrat. I think they've been paying out a dividend for like 30 or 36 years or something like that. But they're great in that sense. But what is really sort of putting me to place Rowe Price here in this C tier, or this grade C, is their product. So I believe that active management, because they engage in what is called active management, so picking stocks or putting you in a mutual fund or one of their ETFs that is actively managed, where they actually pick the companies that fund holds. I believe that that's still going to be relevant for the future. People are still going to have these products. It's not going away anytime soon, even with the uptake in passive investing. But what I think is actually going to maybe impede their growth is their ability to have these other products. So they've come out with their own ETFs recently. They've been doing okay, but they're very behind in terms of market share in those passive investment products. So like BlackRock right now, they're the number one asset manager in the world. I think they have like $10 trillion of assets, and they have a huge stake in their iShares ETFs, which are passively managed, and then they charge those fees on. Just by virtue of being behind BlackRock that much, I don't believe T. Rowe really warrants to be in a higher position here on this tier maker when I compare it to my other companies. I still think it's a great company. The financial metrics are sound. It should be, provide a decent annual return, but I actually am rethinking my T. Rowe position. Even last week when I made my video, the whole time I was thinking about it. The financial metrics are great. They've had a great history. There can be specific attributes of a company in which are not quantitative but qualitative, which actually might outweigh those quantitative aspects. So in terms of future growth, I do really need to think about this and think if T. Rowe fits within my dividend growth portfolio investment thesis or investment philosophy. Now, a lot of times when I think about that, I think, well, if I had sold T. Rowe or had the funds from here, could I invest them into one of these great S tier companies and get a higher return, or one of these great A or B companies? And the answer might be yes. So I'm going to be thinking about that this week. So sorry, that was a little bit of a rant there, but at the end of the day, I'm giving T. Rowe a C rating, or a grade C. Norfolk Southern Railway, this is going to go into the B category. So NSC, now they have the railway on the eastern side of the United States. Great company. I decided to buy them on weakness because of their derailings as of late. And again, that speaks to my conversation before, talking about the difference between the Canadian railways and the United States railways. In terms of safety, I think the Canadian railways have a much more stronghold, or a stronger position, or a stronger, I want to say, system in the way that they deal with their safety regulations and the safeguards they have there, as opposed to the United States railways. So NSC, great railway, has had a history of delivering great shareholder returns. They buy back a lot of shares. They issue dividends, very similar again to all of these railways. They operate very similarly, but I believe that it's not really up to, again, I'm comparing NSC to UNP and CP. I don't believe these two railways are up to the standard that CP is at, or CN. I just haven't invested into CN yet. So we'll give NSC a grade B here. Now, Manulife Financial Corporation, I'm teetering between B and C. I'm going to give it a B. You could easily call it a C. I don't think it's at the A tier. Manulife Financial Corporation, great corporation here in Canada. Strong dividend payer, strong dividend growth. The only thing is that they have not really had high shareholder returns in the past couple of years. So that is why I am going to give it a B grade, or a B rating. I just believe that, they have had great metrics. The only thing is their financial performance it's very shaky sometimes. And I think that they have a great avenue for growth. Like, they have essential products such as life insurance. They also do asset management. They have group benefits. So they do have a lot of areas for growth, and they are expanding into Asia, and hopefully that goes well. It's kind of been underway for a while, and it hasn't materialized like a lot of people thought. But I do believe that with their growing dividend, their share buyback program, that they will provide a lot of shareholder return in the future. But again, I do not believe that they are in the A tier here. I would give them a B rating. Now, if they prove me wrong and they actually do pull off expansion quite well, I will be a happy shareholder and would be happy to move them to this A category. So now that I'm looking back and reflecting on this, I really do think this was a very useful exercise in terms of ranking the companies in my portfolio. So ideally, what you would like is to have all of your companies in this S and A tier here. But now when I look at it, I actually have a decent amount of holdings in the B and C tier. So I'm going to have to do some thinking and think back. Now, realistically, there are only so many companies that you can invest in, and only so much you want to invest into each of those companies in terms of diversification, and whether you want to have a concentrated portfolio or unconcentrated portfolio, or have a what you would call a diversified portfolio in terms of how comfortable you are with diversification risk or concentration risk. But in my opinion, I believe that a lot of these B companies are probably still poised for pretty decent growth or market beating returns. This one I just might have to think about in the future, and I'm comfortable holding these ones, no doubt in my mind. I think these will all perform very, very well. And again, it might just come down to, in terms of allocation percentage and those qualitative factors. Like I said, it's not always about the numbers, people. Some of it is also about the facts behind the company and their future growth. So I hope you enjoyed the video. That was kind of a long one, but I thought it'd be a useful exercise to rank these companies for both myself and for you watching my channel, and I hope you enjoyed the content. If you did, please leave a like and subscribe to the channel. I welcome any and all comments on whether you think I rated my companies correctly, whether you have a different opinion of how you would have rated them, or other companies that you believe belong on this list. Please feel free to let me know in the comments, and I will do my best to get back to you when I can. So thank you for watching, and I hope you have a great day. Thanks. Bye. Please note, I am not a financial advisor by any means. This video was merely for your entertainment purposes only. Please do your own due diligence when researching or investing stocks, as I am not liable for any investing losses you may incur. Thank you. Have a great day. Bye.